In this session, we'll explore the various types of multiples. Which multiples have you heard before? Among them, probably the most well-known multiple is the price to earnings multiple, or the PE multiple, or the PE ratio. Even if you're not a finance professional, you probably have heard of this at least once. And this is calculated by dividing the stock price to earnings per share. So dividing stock price to EPS, or if we multiply the stock price by the number of shares, it gets us to market cap divided by net income. Either way, it's the same, but usually because the calculations are much more simple for this one, so market cap divided by net income, because EPS, you have to calculate EPS just once more, so it's much more convenient to approach this way. But anyways, what's important is that this multiple is so widely used because it aligns the numerator and the denominator. So what we're doing is we're trying to value a stock. We are interested in the value of a single stock, and here the numerator and the denominator, they both represent shareholders' perspective. So the viewpoint is pretty much aligned, and this is what makes the PE multiple very intuitive, very straightforward, and probably that's why it naturally become the most famous multiple. But the P multiple does have its clear limitations because number one, what's going to happen if net income is negative? It's not only for our target company, but also our peer groups all have to have a positive net income if you want to use this ratio. But in actual practice, as you all probably know, it's very uncommon for many companies to have positive net income, especially over some time period. So unless it's a very stable industry, so a very mature industry, PE multiples are sometimes very difficult to utilize. And there's just one more problem with net income is that, well, net income, it does fluctuate a lot. In other words, it's very volatile. So because net income, it's at the end of the income statement, and what happens is that there are so many various income and expense items in between. So it includes many one-off events, or it includes also tax changes, things like those. It results in significant fluctuations. So depending on the timing of the analysis, the PE multiple can be very volatile, and well, this really undermines the reliability of the PE multiple. So so as a result, we're looking for alternatives of the PE multiple. We're looking at the income statement that is less likely to result in a loss and maybe less fluctuating, so less volatile. What do you think? It's a very good choice. That's right. It's going to be operating profit, or if we add depreciation and amortization, it's going to be EBITDA. And this is where the EV/EBITDA multiple comes into play. So instead of using net income, we're using EBITDA on the denominator, and this is way much less volatile than net income, relatively. And this might reflect better a company's fundamental performance. So as a result, EV/EBITDA multiple, it becomes much more applicable for loss-making companies, and it provides a more stable benchmark during our comps valuation process. But we have to focus on the numerator as well. We're not using market cap of equity or equity value for this multiple. Yeah, because EV/EBITDA, the EBITDA is a metric for the entire investors. So it represents the entire investors. It includes shareholders, creditors, preferred shareholders, and so on. So the solution was to use enterprise value to match the viewpoint instead of using equity value. So as a result, EV/EBITDA multiples, it really has a huge advantage. Number one, we can use it across various scenarios, even early stage companies that does not yet have a very stable net income. We can use EBITDA multiples. So the usage is much more wider, and despite the fact that when we're calculating EV/EBITDA multiples, it's very, very relatively annoying compared to when calculating PE multiples. We have to calculate the EV, and even EBITDA is not usually calculated in the financial statements. We have to calculate them ourselves. So it's very annoying to calculate this EV/EBITDA multiple. But despite that, I think at this time, it's the most frequently used multiple in this field. Let's move on. What are we going to do even if EBITDA is negative, or even if EBITDA is unstable? So in that case, well, we inevitably have to go up to sales or revenue. So because revenue, it can't be negative. So this is where EV to sales or price to sales, it comes to play. Of course, there's a critical flaw in using revenue as a basis because it completely ignores the company's cost structure. So in other words, this approach evaluates a company's value solely on revenue's size. It doesn't really care about how much the company spends in terms of expenses. So again, it can be much more applicable to a more wide range of companies because we can use it for startups or very, very early stage companies with negative EBITDA. But when it comes to EV to sales, now the problem is that it seems much less reliable. So as we come down, the usage is wider, but the reliability is going down and down as we proceed. And finally, there can be companies that even does not have revenue at this point. So very early stage startups like in Series A or seed stage or things like those, they don't even have a stable revenue. So in such cases, we use alternative metrics like MAU, monthly active users, number of downloads, subscribers, or pipeline counts in biotechnology. We use our targets specific performance metric for the denominator. And for example, if you're evaluating the value of a YouTube channel, for example, maybe we're going to be interested in metrics like the number of subscribers or the number of views per video. They can be very useful for the basis for valuation. So even when there's no revenue, we try to look for any meaningful metrics within the industry to guide the valuation process. In the end, multiples can be constructed in a wide variety of ways depending on the combination. So on the numerator, usually it consists of equity value or enterprise value, while the denominator can include any performance indicators such as sales revenue, net income, EBITDA, downloads, just anything depending on what best represents the company's performance. But I would have to say, among the multiples, usually it's most ideal to first try to use PE multiples if possible. But if it's not suitable, we go down to EV/EBITDA and then to EV to sales, and then, for startups, other metrics as well. And of course, I think it's also worth noting that even when valuing the exact same company, individual analysts have different approaches and they use different metrics. And because of that, sometimes there are debates on which multiple is most appropriate, and sometimes in an M&A deal, maybe there's going to be a long meeting on which multiple to use. And yeah, I think this is the characteristic of corporate valuation, because we don't have a single correct answer. Valuation, it involves subjective judgment from each individual analyst. So anyways, this concludes the explanation of our various multiples. I think if you have understood this much, you can now move on to practicing by calculating and applying multiples using real data on actual companies.